we take a look at determination of cash flows for investment decisions in financial management. My name is Mr. William, Fatima Institute. Subscribe to our video, like our video in case you need any help. My contacts are 0727871093. We are publishers as well as authors. In case you need books for revision and study materials, contact my number at 0727871093 as it appears in the footnote. Also, classes are available physical and online. Let's look at determination of cash flows for investment decisions. Capital project cash flows are classified into three categories, namely total initial cost. Number two, total terminal cash flow. Number three, annual net operating cash flows. Total initial cost is basically the total initial cash outlay, which is determined by summing up the following. One, the total cost of the asset. Number two, all other incidental costs which relate to the acquisition of the asset. These costs are usually capitalized so as to form part of the asset. They include insurance, freight charges, import duty, installation cost, etc. So one of the costs that we will be considering is the total initial cost. This comprises of the total cost of the asset. If you purchase an asset at shillings 1 million, then any other costs which have been incurred up to the point when this asset has been put into use are known as incidental costs. Examples here are insurance and import duty and installation cost. If you purchase a machine, for example, from United States at 200,000 shillings, then you incur insurance on the same, you incur freight charges, you incur import duty, you incur installation cost, then the total initial cost of that asset will be the purchase price of the 200,000 shillings plus any other cost which has been incurred up to the point where this asset has been put into full operation. The total initial cost is computed as follows. You can see the format there. You will be picking the purchase cost of the asset, then all incidental costs like transport, insurance, import duty, installation cost. Sum up all this, you get a certain figure here. Then you earned working capital adjustments. Working capital means current assets and current liabilities. They are adjustments. If, for example, you purchase a new machine, such a new machine may result to increase in the stock or decrease in the stock, increase in debtors or decrease in debtors, increase in creditors or decrease in creditors. Whatever effect that the acquisition of that asset may have on your on your working capital items, then you have to do that adjustment. If the changes in working capital occur by the start of the economic life of this asset, then such cost should form part of the initial capital. However, it should not be used for the purpose of depreciation of that asset. If the changes in working capital occur by the end of the economic life of the asset, then such should be part of the terminal cash flow. So all these changes in working capital should be recovered by the end of the economic life of the asset in question. So look at that format. Then I move to page 24. Now in page 24, we have explanations here for working capital adjustments. Working capital may be incurred at the beginning of the investment period or as the project progresses. If the working capital was incurred at the initial stages of the project, it should be capitalized to form part and parcel of the initial cost but should not be depreciated. If the working capital was incurred any other period, it should be considered to be part of the cash outflows for that period and should not be capitalized. Total working capital, regardless of when it was incurred, will be recovered at the end of the project's life. The working capital recovered will be considered as cash inflow at the end of the project's life and will be discounted together with other cash flows at the end of the project's useful life. Working capital refers to the current assets and current liabilities. A new capital project can result to increase or decrease in the working capital items, e.g., debtors may increase or decrease. If the net increase in the working capital items occur at the start of the economic life of the asset, such as increase or change should be treated as an initial cost. If the change occurs by the end of the economic life of the asset, then such a change should be treated as a terminal cash flow. The reason being that the additional investment in working capital will be recovered. When computing the working capital adjustments, the following rules must be observed. Increase in assets, you earn. Decrease in assets, you less. It will be the opposite for liabilities. That is, increase in liabilities, you less. Decrease in liabilities, you earn. Current assets may comprise of stocks, also known as inventory, debtors, also known as receivables, bank or cash, accrued incomes, and prepaid expenses. Mostly, the current assets in this area will be stocks and debtors. Current liabilities mostly, in our case, will be creditors or payables, but others may be accrued expenses, bank loans, and overdrafts. So that is to do with initial capital outlay. To get the initial capital as our first item, we said you take the purchase cost of the asset, you plus any incidental cost, any other cost which has been incurred to bring into use this particular asset. Then working capital adjustments. That is, if you purchase a machine and then as a result, it brings some changes on the working capital, and these changes are occurring by the start of the economic life of the asset, then such a change should be part of the initial capital, or the initial cost rather. The other item will be total terminal cash flow. This refers to the cash flow that will be realized at the end of the economic life of the asset. It comprises of salvage value. This is also called the scrap value, residual value, disposal value. It is the value of the asset at the end of its economic life. Then working capital recovered. So for us to compute total terminal cash flow, we take the salvage value, that is, you purchase an asset and you use it for several years. Assume that this asset has a salvage, as an economic useful life of 5 years. Then by the end of the 5 years, you are able to sell this machine as a scrap. The cash flow generated out of this is what we call salvage value. So to get total terminal cash flow, you consider that salvage value or the scrap value, you plus the working capital recovered. We've said that if you acquire a machine and then the changes in working capital are occurring by the end of the economic life, then those changes in working capital should be part of the total terminal cash flow. But if the changes are occurring by the start of the economic life of the asset, then such a change should be part of the initial capital. However, it should not be used for the purpose of depreciation. The last is annual net operating cash flows. This is the annual cash flow arising from the operations of the firm. To compute the annual net operating cash flows, we consider annual total revenue, which is given by quantity sold times selling price per unit. We also consider total variable costs, i.e. costs which vary with the activity level, such as electricity and water. Then C, annual fixed operating costs, which is computed as follows. Our format is here. We want to see how to calculate net operating cash flows. You'll be picking annual sales, take the quantity sold times selling price per unit, you minus variable cost to get annual contribution. Then from the annual contribution, you minus fixed operating costs, excluding depreciation, you get EBDT, earnings before depreciation and tax. Then minus depreciation, you get EBT, earnings before tax. Less the tax, you are left with earnings after tax, which is also called the accounting profit. Out of the accounting profit, we earned back the depreciation, and after that, you get net operating cash flows. The other way of getting net operating cash flows, once you have earnings before tax, earnings before depreciation and tax, you can multiply the earnings before depreciation and tax, multiply it by 1 minus tax, then you plus DTS. DTS is given by depreciation per year times tax rate. Let's continue. There are two major methods which will be used in computation of depreciation, namely straight line method and reducing balance method. Most of the times, straight line method in financial management is the common method. As discussed earlier, under the sources of finance, depreciation is one of the sources of finance. Provision for depreciation is the money set aside so that when the asset has fully depreciated, the business will have set aside enough funds to replace the asset. This money can be used as an internal source of finance. When making budgeting decisions, we assume that provision for depreciation replaces wear and tear. Hence, it will attract tax shield. That's depreciation tax shield. DTS is a reduction in the tax liability, i.e., tax saving. It thus implies that if provision for depreciation is not accounted for, the tax liability will be greater and the company may require a tax refund of the excess tax paid. Such a refund is a cash inflow to the business. DTS is given by depreciation times tax rate. Annual net operating cash flows can be computed as follows. So this part here, this net operating cash flows, once you have earnings before depreciation and tax, instead of first lessing depreciation and tax and then adding back depreciation, once you get your earnings before depreciation and tax, you can just multiply the earnings before depreciation and tax by 1 minus tax rate, then you plus DTS, and DTS is given by depreciation times tax rate. By so doing, you will have calculated the net operating cash flows. Alternatively, NCF, the net cash flows can be given by, you can just take earnings before depreciation and tax minus tax, then you multiply by 1 minus T plus depreciation. But the first, this one is quite easier and more faster. Let's take an illustration, an example. Elon Limited intends to purchase a machine whose cost is shillings 4.8 million. The installation cost is shillings 600,000 and will have a scrap value of shillings 500,000. An increase in working capital at the beginning of the investment period is required. This comprises of increase in stock by shillings 400,000, increase in creditors by shillings 250,000, and increase in debtors by shillings 150,000. A further increase in working capital of shillings 200,000 will be required at the end of the year 3. The cash flows for the project are given below. Years 1 to 5, cash flows for year 1, 1,400,000, year 2, 1,620,000, year 3, 1,300,000, year 4, 1,200,000, year 5, 1,500,000. The required rate of return is 13%. Required, determine the net present value of the project. So after that, you can pause your video and you write that question somewhere so that you may look at the solution. Understand these changes in working capital, such as increase in stock by 400,000, increase in creditors by shillings 250,000, increase in debtors by shillings 150,000. Then a further increase in working capital of shillings 200,000 will be required at the end of the year. Those are important items. Remember that The cost of the machine is 4,800,000. That is the initial cost. We've said you take the initial cost, then you plus incidental costs, and then you also plus the working capital adjustments. If the purchase of this machine will result to changes in working capital by the start of the economic life of the asset, then those changes in working capital should form part of the initial capital. Okay, I believe you've taken a note of that. So let me move to page 26. The solution now. The solution is there. We have taken initial cost. We are told that machine cost 4,800,000. The only incidental cost was installation cost, 600,000. So depreciable cost is 5,400,000. Working capital. The changes in working capital occurred in or by the start of the economic life of the asset. So the stock increase, you have said if assets increase to be a plus, stock increased by 400,000, debtors also increased by 150,000, creditors increase, you less 250. So changes in working capital is 300,000. If you adjust this, 400 plus 150 is 550. 550 minus 250 is 300. So 300 is the changes in working capital. So if you purchase a machine and the changes in working capital occur by the start of the economic life of the asset, then such should be part of the initial cost. That is where you have taken 5.4 plus 300,000, which is 5,700,000. But when you start depreciating this asset, you will not use 5.7. You use 5,400,000 for the purpose of depreciation. That is why we are saying this is known as depreciable cost, 5,400,000. But this is the initial cost. Away from that, so we have our initial cost. Remember, the net, how we calculate the net present value is the present value of the cash flows minus the initial cost. So when you come to our solution here, you find this initial cost here. Initial cost of 5,700,000 has been deducted here. We have deducted 5,700,000 here. So let's see now, we have our initial cost is 5,700,000. So you come to these cash flows now, which have been given. These cash flows, I think you have taken these cash flows here. You have them, those cash flows there. The cash flows for the project are given below. Cash flows for year 1, cash flow for year 2, year 3, year 4, year 5. Year 1 is 1.4, year 2, 1.62, year 3, 1.3, year 4, 1.2, year 5, 1.5. The required rate of return is 13%. Now, having that, we come back on the other side. We come back on the other side where we arrange our number of years here, 1, 2, 3, 4. The cash flows just as they have been given, but in year 5, we have salvage value. We sold that machine at 500,000 in year 5. So in year 5, there are two cash flows. One is 1.5. Year 5, you have cash flow of 1,500,000 and the other of 500,000, the salvage value. Now in this column, we have present value interest factor. These cash flows are irregular, so you need to, they are not annuities. So you need a column here for present value interest factor. If 13% is not in your present value interest factor tables, you can calculate these figures by taking 1 plus r raised to negative n. For example, year 1, this number 0.8850, you have taken 1 plus 0.13, you close the brackets, raised to negative 1. Negative 1 is here. If you come to year 2, how to calculate 0.7831, which is 1 plus 0.13, this 13%, raised to negative 2. For year 3, 1 plus 0.13, then you close the brackets, raised to negative 3. That way, until year 5. Now, once you have that column for present value interest factors, the next thing is to get present values. So you just multiply these cash flows times present value interest factors. These are the present values now. Just multiply to get this column. Then finally, remember there is working capital recovered. The present value of the working capital recovered. One of the working capital recovered, we have said is here 300,000, and the other, the 200,000, where that one is coming from, is this part here. This part here, where you said a further increase in working capital of shillings 200,000 will be required at the end of year 3. That will be a cash flow you require. We will require that amount. Okay, those are that is that. I think you understood here. The working capital recovered. It is year 5. You use 0.5428. Then present value of cash flows. Sum up all this. If you sum up all that, that is, you get 5,362,882. You minus initial capital outlay, which is initial cost 5.7. This one here. This is the initial cost. You less that. You less 5,700,000. So this present value of cash flows, you minus this initial cost, you get the net present value of negative 337,118. This is a negative net present value. So, otherwise, do not replace the machine because it will result to a negative net present value. I think you note how we have calculated cash flows for year 3. This year 3, 1100. We are not using 1300 because from the question you can see it is 1300. From the question, it is 1300, but we are using 1100 because we have been told that a further increase in working capital of shillings 200,000 will be required at the end of year 3. So basically that is how we should have worked out that. You can just go through the solution, read the question and look at our solution, what we have done. Note that costs can either be initial cost, and initial cost comprises of the purchase price of the asset plus incidental costs, any costs which can be incurred or which will be incurred to bring this asset into use, and working capital adjustments. If you purchase a new machine, it may have an effect of either increasing your assets, your current assets, or decreasing your current assets, increasing your current liabilities or decreasing your current liabilities. That is the working capital. So the initial cost you'll be considering, purchase cost, how much you have spent to acquire the machine. Then any incidental costs like installation cost, insurance, freight costs, import duty, you sum them together to get depreciable cost. Then working capital adjustments, that is, if the changes in working capital are occurring by the start of the economic life of the asset, then such changes in working capital should form part of the initial cost of the asset. Note, however, that when calculating depreciation, you will not use the figure which is inclusive of the working capital. You will depreciate the asset using the depreciable cost. Like in our case there, if you had to depreciate this asset, we should have used 5,400,000 and not 5,700,000. Then the other is the salvage value. Salvage value, if you plus the working capital recovered by the end of the terminal cash flow. Let me just show you what I'm saying. I'm just repeating what we've done. I'm just summarizing what you have done. What I'm referring to is this part here. The total initial cost, total terminal cash flow, and annual net operating cash flow. So total initial capital is what you've done there. You can see what has been done here. The format is here. To get the total initial cost, you can see here, we are saying you earn working capital adjustments. And then the other part, the other cost is terminal. I want you to see it. I want you to see terminal cash flow, the terminal cash flow, how we go about it. This part here, salvage value, and the working capital recovered. That's a total terminal cash flow. The annual net operating cash flow, those three, you follow that. You follow this. But once you get earnings before depreciation and tax, you can just multiply this by 1 minus t. For example, tax is that percent. You just multiply this by 1 minus 0.3. Then you plus DTS. DTS given by depreciation times the tax rate. Then we have explained what we are saying here. And then our example, we've given a good example here. We have given a very good example here, which starts there. And it has given us a negative net present value. Our workings have taken us to, after getting the initial cost here, then our cash flows were here. There was a salvage value. There was working capital recovered. We deducted the initial cost. we got a negative 337, 118. So we advise this company not to replace the machine because it will result to a negative net present value. A negative net present value means that if we acquire that particular asset, it will reduce the value of the farm. But if it was positive, we usually accept the project because such an acquisition will result to increase in the value of the farm. Next time, we will look at replacement decisions. That is enough for that. So make sure you subscribe to our YouTube. You also like our video. You make a comment. If you have a question, my contacts are just there: 0727 87 10 93. My name is Mr. William.